Dividend growth is a key ingredient of a stock's performance, and the real magic is when that passive income starts compounding. Friends and family, my name is Amos, and today we're going to be looking at 18 companies that are rewarding their investors simply by being handsome. Look at you. Look at that smile. Look at that receding hairline. And these companies in question, they are raising their dividends and giving their shareholders like you and I a pay raise by doing nothing at all except by holding on to them. And by the way, dividend growth is so much more important than you think. It signals confidence from the management team, strong cash flow, and a business that's reliable and predictable. After all, you cannot consistently grow the dividend if your sales and operations are volatile. Ba-da-ba-ba-ba, dividend compounders with cheese. And to kick things off, the first dividend compounder is going to be Best Buy, ticker symbol BBY or BABY. They raised their dividend payout by 1%. Current dividend yield is about 6.1%, depending on when you look them up. Could be as high as 6.5%. And when it comes to Best Buy, I have their rating as no way Jose. Because, their business model as of right now, it makes sense. As they are catering towards an aging population, they're essentially a showroom for Amazon, and they provide in-person tech support with the Geek Squad. And if you're over the age of 70, I think more likely than not, because there's no more Radio Shack, you're going to go to a Best Buy in order to buy a new electronic device. For that exact same business model, plus exposure to a streaming service that I think is Netflix 2.0 and a sponsor of Major League Soccer, I would rather go with Apple. I'm absolutely bullish about the growth of soccer here in the US, and Apple TV will ultimately benefit from that explosive growth. And another thing about Best Buy that I don't really like is that their top line, their gross sales has been pretty much flat since fiscal year 2018. However, they have been growing their dividend for the past 21 years, so I will give credit where credit is due. Plus, the payout ratio is 75% for an established, mature retailer. I think that's more than healthy. Colgate-Palmolive, they increased their dividend payout by 1.9%, ticker symbol CL, and they're a decent enough consumer staples company that sells toothpaste, laundry detergent, and other household essentials. But even in their own category, they're not the best. I would rather go with the best in class, right? When an entire neighborhood goes on sale, why not just go for the best house on the block? Why go for the third best, right? So in their own category of consumer staples, selling the exact same thing that they do with a different brand and label, number one would be Procter & Gamble. Runner-up would be Church & Dwight. Colgate-Palmolive, third place, but even though they're in the third place, it doesn't mean that they're a disaster of an operation, because their dividend yield is 2.3%, and I think that's pretty decent. However, I think where they get a lot of brownie points with me is they've been growing their dividend for the past 63 years in a row. So think about all of the major catastrophic events that have happened in 6 decades. Through it all, time and time again, they have raised their dividend. So I think that's simply amazing. However, having said that, I believe in the vision and the future of Procter & Gamble more so than I do for Colgate-Palmolive. All else being equal, I would much prefer Procter & Gamble, but at the right price, I would entertain having Colgate-Palmolive being a part of my portfolio, and that's why as their rating, I have maybe. Now, the next dividend compounder is going to be Dick's Sporting Goods, ticker symbol DKS, and they raised their dividend payout by 3%. Their current dividend yield is sitting at about 2.6%. Sometimes it does fluctuate down to 2.2 to 2.9%. It depends on their share price appreciation or depreciation. And the payout ratio being 49% is more than healthy. Now, when it comes to Dick's Sporting Goods, I think the youth sports scene is getting bigger than ever. Every family is trying to have their kid participate in an extracurricular activity, right? And I think sports is one aspect of it. And when it comes to buying sports equipment, such as cleats, gloves, or whatever it is, you want to feel it in your hands and on your body. You don't want to buy the wrong size. So I think their business model, given what they're doing, I think it's going to be resilient in the face of AI, and dare I say, in the face of Amazon to a certain degree. However, I do think they will face pressure from Walmart and their great value in-store products, offering about the same thing that Dick's Sporting Goods does, but at a fraction of the cost. So the reason why I have it as no way Jose, I just don't see them having an economic moat or a competitive advantage. So I would rather go with Walmart. And the next dividend stock is Build-A-Bear Workshop, ticker symbol BBW, and they increased their dividend payout by 4.5%. Their dividend yield, also very similar to Dick's and Colgate-Palmolive, it's 2.3%. Payout ratio is 22.3%. And I'll just say this when it comes to Build-A-Bear. I think their comeback story needs to be studied because during the pandemic, in 2020, when the shopping malls and everything else closed down by mandate, this company, they were on the verge of collapsing and declaring for bankruptcy. But in 2026, they're thriving. And their stock performance for the past 365 days, take a look at it, 9.5%. If we do the past 5 years, 445%. Yes. A place where you can go to buy a customized teddy bear, 445% into the green with just the share price appreciation. Obviously, if we bake in the dividends, I think the total return would be a little higher. I think that's kind of crazy because I personally would never invest into a retail chain that sells only teddy bears, right? And I think they're trying to diversify their business model to implement digital media as well. But, when I think about the behavior of the customer, when times are hard, I don't think it takes a rocket scientist to understand that a teddy bear at the shopping mall will be the first thing they say no to. I think there are other aspects of life that take precedence and priority. That's why, all else being equal, out of the 4 that we have covered so far, I would rather go with Colgate-Palmolive because their business model makes money when the times are good or bad. We're always going to need toothpaste or laundry detergent. It's not a sexy, flashy business model, but it's boring and it's stable and it's consistent. And I think I would prefer that over a teddy bear retail chain. But I will not belittle the fact that their stock market performance probably rivals that of Nvidia or Palantir. I just think it's outrageous and props are due. That's pretty amazing. Now, the next dividend compounder we are going to address is Wyndham Hotels and Resorts, ticker symbol WH, and they increased their dividend payout by 4.8%. And not too long ago, we covered this company in depth on the channel, so it is pretty fresh on my mind. Their dividend yield, once again, just like the other ones we have talked about so far, is sitting at 2.2%. Payout ratio is 66%, so it's sustainable, it's healthy, and when it comes to Wyndham, I would say they have a pretty diverse portfolio of hotel chains that appeal to just about everyone, but their main bread and butter is the everyday traveler, and that's because I think their biggest driver is Days Inn and Super 8. And something you have to understand about this business operation is that they're not the ones that are doing everything in the operations and handling customer support, right? And that's why I really like the franchise business model. The parent company, Wyndham, they collect fees and royalty checks from the franchisees that own like 3, 4, 5 of these hotel chains in a 5 to 10 mile radius. Another one is McDonald's. They're not the ones that are flipping and making the burgers. They're selling the intellectual property, the menu, and most importantly, the real estate you rent from McDonald's corporate. So I would much rather invest into Wyndham versus Airbnb. And that's why as their rating, I have it as a maybe. Obviously, there are about 100 other companies that I would consider before I contemplate jumping into Wyndham. And because during the pandemic they were a dividend cutter, it would only be for a short-term trade. Now at this point in the video, I just want to hop on my little soapbox that I got from Temu and talk to you and articulate why I like dividend growth investing so much. So right now, most of them, the companies that we have covered so far, the dividend yields are not crazy, right? It's not 10%, it's not 15%. So the payouts, you might only be getting $1 in dividends per share that you own today. And I hear you, that doesn't sound like much. However, if that company keeps raising its dividend, such as Wyndham Hotels and Resorts by 4.8% every year, 8%, 10%, that $1, friends and family, it'll quietly turn into $1.10, and then $1.25, and then $1.50. And before you know it, your income, by holding on to that single share, it'll have doubled by virtue of doing nothing at all. And that's why dividend investors, they understand the concept of being disciplined and being patient, buying and holding and not doing anything at all, because behind the scenes, you're going to be paid more every single year because of the dividend growth rate. And here's where it gets really interesting. Your yield on cost. For instance, right now, Colgate-Palmolive, their dividend yield is about 2.3%. It's nothing crazy, and for most of you, you're probably rolling your eyes saying it's not good enough. But give it time. Let it marinate. Let the juices and the flavors come out in the oven, and 5 to 10 years later, because the dividend kept growing, you're not going to be earning 2% on your original investment. Even though its current market yield is 2.2%, if we go back 5 to 10 years, your yield on cost, it might be 6%, 8%, and in some cases, it could be as high as 10%. So all I'm trying to say is a company raising its dividend every single year, giving you that raise without you working, dude, sign me up. And I don't know about you, but I like investing into businesses that treat shareholders like partners and the ones that are disciplined with their capital allocation. Because believe it or not, there are companies out here who do not care about the shareholders, and they will burn through cash and spend recklessly on R&D, on marketing campaigns that may or may not pan out, and they don't care about the partners, the investors, the owners of the company. And that's why, at 35 years old, I prioritize dividend growth investing. All right, I'll stop preaching to the choir because the guy in the back is falling asleep and his wife's getting embarrassed. Let's get back to the video. And the next dividend compounder in question is Macy's. Ticker symbol M. And I do believe they used to be the one that hosted the Thanksgiving parade in New York City. I'm not sure if that's still a thing after the pandemic, but they raised their dividend payout by 5% if we were to round up. And their dividend yield right now, I'm not going to lie to you, it's pretty good. It's 4.3%. It's not as juicy as Best Buy's 6%. However, the payout ratio is 43%, which means, let's take a break. What does that mean when I say payout ratio 43%? It means out of their profits, right, the bottom line of the company, after taking into account the overhead costs, how much you pay your employees, how much it costs to buy the equipment and everything else, what's left over that's going into the pockets? That's your bottom line, your net income. And of that, they utilize 43% of it to finance the dividends, which means they're going to have a little over 57% left over to reinvest back into the business, to grow the business, to do whatever it is. It's always good to have a little excess cash left over because there's always going to be unexpected setbacks or an opportunity for an acquisition. If you're utilizing 90 or 95% of your profits for the dividends, then think about it, right? If someone were to walk into the corporate building's lobby and let out a small little fart, that might be enough for the company to croak or go belly up, because they're not going to have enough cash to be able to hurdle a speed bump. So the lower the payout ratio, the better it is, in my opinion. Now, obviously, if it's an established, mature company that's been in business for over 100 years, I think a high payout ratio of around 70 to 80% is pretty much expected. But for Macy's to be at 43%, I think that's pretty good. If I were to scroll down and take a look at what happened, though, during the pandemic in 2020, they slashed and cut the dividend. So they basically started all over again. And that's why the dividend looks so sustainable. So if you only take into account the past 4 years, then Macy's, as a dividend-paying business, is phenomenal. But if you take into account the past 10 years, I don't know about you, but I really don't like companies that cut the dividend, because it's proof in the pudding that their business was not as strong as once believed. If you have to cut the dividend, it also breaks the trust between management and the shareholders, because you are not able to forecast properly. But also during a catastrophic event such as the pandemic, believe it or not, I think it was something like 80% of the S&P 500 companies, they maintained and raised their dividends. Whereas the bottom, like 20%, they either kept it flat or they shrank their dividends. So in this case, Macy's would be a part of the minority of companies that cut their dividends. So it shows me that they're not high quality, especially against the broader market. And referring to my own video and research, about 15% of large cap public companies cut their dividends during the pandemic, which means the other 85% did not cut their dividends. So that even makes it worse that Macy was a part of the 15%. And for consumer discretionary spending, because that's what Macy's is, right? You go in there to buy cologne or a new handbag for your wife, or whatever it is, right? They're not in the business of selling toothpaste, food, and other household essentials. And Macy's really tries to differentiate themselves on the shopping experience. And that's why on every floor, you'll have like 5 to 10 salesmen or saleswomen wearing a black blazer ready to help you at any moment. However, for that shopping experience, if that's what you are bullish about, I would rather go with Costco. Because not only can you get a $1.50 hot dog and a drink combo, but depending on the aisle, you could also get a free sample. And don't even get me started on their warranty for most products being 365 days, or I think it might be unlimited. But Costco and the way that they treat their customers plus their employees, for me, I'm very bullish about them, but not at their current valuation. At a PE ratio of like a 45 to a 55, I don't think it makes sense, especially when I take into account their PEG ratio being a 4.2. That is far too high. For a retailer like Costco, ideally I would like to buy into them when their PE is more fairly valued at about 22 to 28. At a 45 and a PEG ratio of 4.2, I'll pass. Friends and family, I think we're going to stop here for now. I'm going to take a break to eat some lunch. So make sure to subscribe to the channel so you don't miss part 2. And I'll talk to you guys next time. Stay safe. Good luck in the stock market. See ya.